Most people hate volatility. They see a 3% dip in the morning and they panic sell. They call it chaos. I call it a discount code. The Trump effect isn't about politics, it's about forced market movements. In 2026, Donald Trump is the world's largest market maker. One tweet, one press conference, or one tariff threat can move trillions of dollars in seconds. To the average investor, this is a nightmare. To the architect, this is a volatility arbitrage. Today, I'm going to show you why you should pray for a volatile market. We're going to discuss the tariff head fake, the endorsement spike, and why movements like drill baby drill is the most profitable sentence in the English language. If you want to be a millionaire, stop looking for stability, start looking for the reactions. All right, let's look into the tariff head fake. Trump talks about tariff and the market dips. Why? Because the big money is programmed to sell on uncertainty. But look at the history. Trump uses a tariff as a negotiation tool. The strategy, when a 25% tariff on Mexico or China is announced at 9 a.m., the noise says the world is ending. The stock drops 8%. By 2 p.m., the market starts to realize it's an opening bid for a deal. The market starts to recover. If you are a value hunter, you don't care about the tariff talk. You care about the discount. If I see a world-class business, let's say a domestic manufacturer or a tech giant, selling at a 10-20% discount because of a headline, I'm buying the discount every single time. I don't care who says what. I care what the asset is worth. The Trump effect creates a dip. You provide the recovery. Now, let's look at the bullhorn effect. When Trump says it's a good time to buy or he endorses a sector, the market doesn't just rise, it shoots. Because he's the president of United States. We saw this with the crypto pivot of 2025 and the housing MBS directive of early 2026. Most sophisticated investors mock these spikes. They call them irrational. Let them be right while you get rich. When the current presidency moves behind a sector, that is a liquidity surge. You aren't chasing, you are recognizing a shift in the global flow of funds. If the administration starts a movement like drill baby drill, I'm not debating the environmental impact. I'm looking at the 55% surge in drilling permits on public lands. I'm investing in the service companies, the pipeline operators, and the energy giants. You follow the movement, you capture the surge, and you exit before the hype turns to noise. Now, we need to understand the architect filter. To be a millionaire in this market, you need a noise filter. If it's a really good business, one with a deep moat and massive cash flow, and it's on sale because of a political headline, this is a gift. The architect doesn't care about why of the discount unless it's a massive failure on the company's performance. Now let's look at the logic. If Nvidia or a regional bank drops because of a regulatory threat that hasn't actually become law, this is a probability play. Most threats never become policy, but the price drop is real. The probability success times potential reward is bigger than the cost of entry. If the MAC clears, I buy. I don't wait for the all clear signal from CNBC. By the time they say it's safe, the 20% gain is already gone. You have to be willing to be wrong in the short term to be rich in the long term. We need to talk about the risk protocol because everything we do risk management. Any business, any trade, any investment needs risk management. You can take the biggest of risks as long as you manage those risks. So what do? We don't over risk. Over risking is using 10x leverage on a headline or putting all your money on one basket. That's how you blow up. Missing is sitting in cash because you are too scared of a tweet. That's how you stay poor. The risk protocol is size for survival. Never put more than 10% of your capital into a single Trump effect trade. Buy the flash crash. Use limit orders set 5 to 10% below the current price. Let the volatility fill your orders while you sleep, and the 48-hour rule. When a massive news event hits, wait 48 hours before selling your long-term winners. The first reaction is almost always wrong. You are a sniper, not a machine gunner. You wait for the fat pitch, the perfect intersection of a policy shift and an oversold asset, and then you swing. You don't try to chase the highest of highs, you chase the highest of high with the best risk management. So guys, the Trump effect is a tool. It creates the friction required to generate the heat. Without volatility, there's no opportunity. If you want to save 7% return, go buy an index fund and wake up in 30 years. But if you want to reach the 7-figure mark in the next 24, 36, 48 months, you have to embrace the chaos. You have to buy the tariff dips, ride the movement surges, and ignore the noise that keeps masses paralyzed. The market is moving, the deal is on the table.